Dollar General stock is one of the few stocks that have performed relatively well amid the stock market sell-off. Investors are curious if Dollar General is a safe stock to buy amid increasing tariffs. I'll answer that question in this video, evaluating Dollar General's stock across financial metrics that are critical for investors, including revealing my intrinsic value calculation using my proprietary discounted cash flow model, which highlights what I believe is a fair value for this business. I'll do all that in this short video, so let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Dollar General stock price at $90 a share is above where it started the year at $75. Very few businesses can say that they've performed relatively well during this stock market sell-off, and Dollar General is one of those businesses. The company's done a great job growing revenue over the last decade, trailing 12-month revenue up to $40 billion. The company did announce that it will be closing some underperforming stores this year, removing the strategy of increasing self-checkout because customers didn't like it. It also led to increasing theft, and trying to add new locations in better performing areas. Consumers are going to face higher costs for almost everything they purchase, and they might look to Dollar General as a store to shop, to save money, buy items at lower prices. That being said, Dollar General's goods are mostly imported, so they will likely have to raise prices they charge customers as well. Nearly every business will need to raise prices that's importing goods because tariffs have increased on nearly every trading partner. There's hardly anywhere to hide from increasing costs. Although Dollar General serves very low-income customers, that customer group is likely to face the greatest pressure as a result of the increasing tariffs. Tariffs, remember, are a tax on consumption. People that are buying these things are going to be paying those higher costs, thereby fueling the tariff revenue that will go to the United States Treasury. Dollar General's cash flow from operations totaled $3 billion in the trailing 12-month period. It doesn't have very lucrative profit margins. Remember, I just shared with you they made $40 billion in revenue and generated $3 billion in trailing 12-month cash flow from operations. That's a less than 10% margin. Couple that with the fact that the business is not expected to grow revenue over the next year, or not to grow revenue by very much over the next year, and you've got some not so desirable circumstances from an investor perspective. The company's return on investor capital has been declining ever since 2021. It's now down to 8.13%. People have been shopping less and less in person, and Dollar General's offerings in store have been declining. The customer service is just about as bad as you can get. I've rarely visited a store or evaluated a business that has as poor of a customer service offering. Limited employees, service from the employees. The employees are not very well trained. The businesses are understaffed. And so it's not trying to improve that performance. It's just trying to offer the absolute minimum type of service it can offer with lowest priced goods it can offer. While that may have been working relatively well, let's say prior to 2018, 2019, that strategy has not turned out to work well following the economic reopening. Now let's look at valuation. So my proprietary discounted cash flow model, which I've created here, starting with the free cash flow, the company generated $690 million in free cash flow in 2024. The analysts on Wall Street expect that to more than double to $1.42 billion by 2029. I'm forecasting those free cash flows continue increasing all the way to 2035 and well beyond. The present value of all of the cash flow I expect this company will generate between today and the very long run is $38 billion. The discount rate I'm applying to these cash flows are 6.92%, with a cost of debt of 7% and a cost of equity of 6.6%. Dollar General beta is just 0.43. That means the business is not strongly correlated with macroeconomic conditions. What that means is if people lose their jobs, they're not going to be less likely to shop at Dollar General. When people get a promotion, they're not likely to be less uh, likely to spend money at Dollar General. So the business performs relatively well, regardless of the macroeconomic environment. That's what makes it somewhat attractive to investors during this current volatility in the worldwide economy. They feel that Dollar General's business will hold up relatively well compared to other businesses that may be more severely impacted by an economic downturn. The company does have a lot of debt, 17.5 billion in total debt, with a market cap of just 15.9 billion. So all that being said, the fair value calculation that I made for Dollar General is $95.52. That's what I believe it's a fair value for this business. The current market price is $89.89. So because that market price is so close to my fair value calculation, I would say this business is fairly valued according to my discounted cash flow model. Now, when I measured the valuation based on the forward price to earnings, it's trading at a forward PE of 14.6, which is near the lowest level this business has traded for going back 3 years. Still, I don't think that's an attractive valuation for this business in the current circumstance, with the return on investor capital falling, with profit expectations declining, and with the increasing volatility due to the increasing tariffs. So, to answer the question, do I think Dollar General stock is a buy right now at current valuations? I would say no. I would say it's a hold. If I'm evaluating it based on buy, hold, or sell, I would rate Dollar General stock as a hold.
Hey everyone, we've got some exciting news to announce. We launched a private Discord exclusively for our channel members at the VIP Discord tier. It's your backstage pass to ask questions, share insights, and get direct access to me. Don't miss your chance. Limited spots available, so join now.